What if I offered to sell you this suitcase full of $1 million? The only catch is you'll get the suitcase a year from now. How much would you be willing to pay today to get that deal? I'm gonna guess that you'd be willing to pay quite a bit less than $1 million. After all, while $1 million next year is still a lot of money, it's not as good as $1 million today. We all understand this concept intuitively, but it actually has a name. It's called the time value of money, and it's an extremely important concept in finance. There's 3 reasons why money today is worth more than money in the future. One is opportunity cost. Money you have today can be spent or invested. You can't do that with money you don't yet have. Another is inflation. When you have inflation, money loses its purchasing power over time. $1 million a year from now won't be able to buy as many goods and services as $1 million today. And third is risk. Going back to the suitcase example, even if you pay me for this now, you don't know if I'm going to follow through and give you this suitcase a year from now. By paying me up front, you're taking a risk that you might not get the money that you're owed. So those are the reasons why money today is worth more than money in the future, and they're the reason why we usually have to pay interest to borrow money. If you want to borrow $500,000 from the bank to buy a house, you have to pay the bank interest because the bank is giving up money today in exchange for money in the future. With all that said, let's go back to the original question, which is how much would you pay me for my suitcase? Well, that depends on your assumptions about the 3 factors that I just talked about. How much do you value having money today versus a year from now? How much inflation do you think we'll see over the next year? And how likely do you think it is that I'll follow through and pay you what I owe you? After considering all that information, you can come up with an interest rate that you can use to convert that future $1 million into a present value. That interest rate is known as a discount rate. Today, the risk-free interest rate, or the interest rate that the federal government pays to borrow money, is around 5%, while interest rates on loans to much riskier borrowers can be 10% or even higher. So if we use a discount rate of 10% on the $1 million received a year from now, we get a present value of $909,000. In other words, if you're okay with a 10% annual return, you should be willing to pay as much as $909,000 for my suitcase. And you can make that same calculation for a suitcase received 5 years from now or 10 years from now. Based on a 10% discount rate, $1 million received 5 years from now is worth $621,000 today, while $1 million received 10 years from now is worth $386,000. So discount rates and present values are very useful concepts in finance. They're not just about hypothetical suitcases full of $1 million. You can apply this same technique to value any sum of money received in the future, including cash flows from financial assets like stocks and bonds. With bonds and other forms of debt, it's really straightforward. The typical bond pays out a certain amount of money periodically and then makes one final lump sum when the bond matures. You can calculate the present value of all of those payments and then add them up to come up with the price for the bond today. Since bond payments happen on such a predictable schedule, people often don't even look at the price of a bond when deciding whether they want to buy or not. They just look at the discount rate that's reflected in the bond's market price, which in bond market jargon is called the yield to maturity. You can look at the yield and know instantly whether the return that the bond is potentially going to give you is attractive enough for you as an investor. Now, when it comes to stocks, things get much more complicated. That's because it's very difficult to predict how much profit or cash a company is going to generate in the future. If we could accurately predict how much profit a company would make every year in the future, we could plug those numbers into a formula, come up with a present value for all of those future profits, and an accurate price for the stock. And some people try to do that using what's known as discounted cash flow analysis. But people who do these types of analyses end up being wrong about a lot of their assumptions because, like I said, it's extremely difficult to know how much money a company will make in the future, and the further out in time you go, the more uncertain it becomes. The economy, competition, and a company's own execution all play a role in determining how much profit a company makes, and they're impossible to predict with any sort of precision. On top of that, even if you could accurately predict a company's future profits, it's difficult to know what discount rate to use to come up with the present value for those profits. The stock market is very volatile and subject to the whims of investors' emotions on any given day. Sometimes people are willing to pay a lot for stocks, other times they're not willing to pay much at all. If you assume too high or too low of a discount rate, your analysis could be way off. Just changing the discount rate by a percentage point or two could have a drastic impact impact on the present value of a stock. These calculations become even harder when you're dealing with private businesses, where it's often tougher to predict how much profit a company will make. And of course, the earlier a company is in its life, the harder this all becomes. Predicting the future profits of the startups that venture capital firms invest in is nearly impossible. So a lot of times what happens is when it comes to stocks and businesses in general, investors come up with a value using multiples. They'll estimate how much revenue, profit, or cash a company will generate over some predictable time frame, like this year or next year, and then multiply that by some number to come up with a price. You might have heard of the price to earnings ratio. That's an example of a multiple. Here's some other examples of multiples. These multiples are a quick and easy way to value businesses without needing to know exactly how much money a company is going to make far out in the future. If the overall stock market is trading at 18 times this year's estimated earnings, investors might look at the stock of a company with really strong growth potential and decide that it deserves a multiple that's 50% higher than the market. So that stock might trade at 27 times earnings. It's a really inexact science, and that's why the stock market is so volatile. Everyone has their own forecast for how much profit companies will make, and everyone's willing to pay a different multiple for those profits. Then you have people using completely different valuation techniques like discounted cash flow analysis and sum of the parts analysis and many others. That's why there's no, quote, correct price for a stock. The market price of a stock is a reflection of the wide range of assumptions and expectations that investors have about a company's prospects. So that's how valuation in the stock market works. But no matter what valuation technique you use, there's something that always holds true. And this applies not just to stocks, but any asset that generates cash over time. All else equal, higher interest rates reduce the present value of cash received in the future and reduce the value of cash generating assets as well. That's why when the Fed lifted interest rates so dramatically in 2022, prices for stocks, bonds, and many other assets fell. Future cash flows that those assets generate are worth less when you discount them back to the present at a higher discount rate. We also saw in 2022 is that a lot of stocks of tech companies and growth companies that were unprofitable and expected to make their profits far out in the future were most impacted by higher interest rates. The further out in the future that you receive a sum of money, the more that money's present value is impacted by changes in interest rates. $1 million received 10 years in the future is going to be more impacted by rising rates than $1 million received 5 years in the future. This, of course, doesn't mean that interest rates are all that matters when it comes to valuing stocks and businesses in general. Growth rates, competitive positioning, and investors' confidence in a company's business model often have a bigger impact on stocks than interest rates over the long term. It's just that this past year has been very unusual. Interest rates have risen a lot and in a very short amount of time. That usually doesn't happen. Usually interest rates are a factor that's in the background and they move relatively slowly, so they don't have a huge impact on stock returns on a day-to-day or even a year-to-year basis. Hope that helps, and follow for more investing insights.